It's time for Charting Futures. Here's Abigail Doolittle. And Abigail, you're starting to look at how risk assets have reacted to the coronavirus fears.
Yes, indeed, Joe. And it's been pretty interesting, of course, over the last 2 weeks on the coronavirus outbreak in China and then spreading to some parts of the world. Risk assets, of course, have been selling off, stocks in particular. But what we've really seen sell off the commodity complex. Take a look at this long-term chart of the Bloomberg Commodity Index in yellow and the S&P 500 in white. We've been looking at this for months because the divergence that I'm about to show has been going on for months. This is actually from the start of the trade war. A look at how stocks and commodities have fared. So at the beginning of the trade war, in the beginning of 2018, both stocks and commodities whipsawing around. But then in June or so of 2018, commodities started to go lower. That was well ahead of the fourth quarter volatility that we saw for stocks. So in a way, commodities a bit of a tell for stocks. One reason why they're less liquid. They're a reflection of the actual demand of products, resources being used in the world. The reason commodities are dropping so much on the coronavirus, China, of course, is the world's largest user of natural resources. So take a look at this. In the fourth quarter of last year, we see that S&P 500 shooting straight up, a parabolic uptrend, perhaps in reflection of the Fed's repo actions. Not so much for commodities, though, still down. And now we see on the coronavirus really plunging by about 9%, 8% over the last 10 days or so, the worst 10 days going back to November of 2018, making the divergence between these two different areas of risk assets stand out even more. At some point, logic would suggest that there's going to be some kind of reconnection. Which way it goes, I'm bringing in Peter Borish to answer that question, a relatively big one, Peter. And that divergence between stocks and commodities, I mean, it's been growing over the last 2 years. But right now, in reaction to the coronavirus, it's stunning to see how much more commodities are going down than stocks.
That's right. And they look like they're going to continue to go down. When I think of commodities, I also think of what's the best way to play that if you're not doing it, which is in yen futures. But also, let's think about each of these commodities around the world. I call it the 6 C's, right? Crude, copper, coffee, cattle, corn, and what was the other one? Cotton, thank you. There you go, right. And so all of them have been relatively weak. You would have think corn would have gotten a bounce after the phase one, did not. So you go on and on and on, and each one fundamentally has their own supply and demand dynamics. Coffee's given back its entire rally, so that's why in the index you're seeing tremendous downward pressure. So what benefits? Well, this chart we're seeing here of the yen, which is really fascinating when you look at the futures.
And these are yen futures, so not to be confused with the dollar yen. So when it goes up, this is actually the haven asset going higher.
That's right. So the yen goes up. And if we think about this for a moment, and if you look at the RSI underneath it, you've seen it's held support. The RSI has not gotten oversold. So now as that RSI moves towards the upper end of that range, the yen is going to move towards its upper end of the range. So in the cash market, we're really thinking about 105 clearly. Here, we're looking at par. There's differences of interest rate arbitrage between the yen and the futures. We're not going to discuss that right now. But what it says is if you think there's going to be uncertainty, risk off. Now, when you look at that chart behind us, that means that stocks are likely to go down faster, right? So there's a correction. Everybody thinks buy commodities. Not necessarily. They can both go down. Trading's a second derivative. So perhaps equities go down faster than the commodities go down. Either way, what benefits? The yen.
Haven asset. So you think yen futures are going to go higher, dollar yen lower, and you would suggest playing that by buying calls on yen futures.
That's right. And you could, if you think it's going to be quickly because of all the uncertainty, you can go out to the March contract. If you want to be a little bit more risk adverse in the trading environment, then you can go out to the June contract and buy calls on yen that expire in June.